Hello everyone, thank you so much for joining the webinar. Apologies, are 1 or 2 minutes late. We were just making sure that all the sound was working in the back end. So just a little bit of housekeeping before we start. You'll notice there's a chat function and a questions box on the top right of your screen. Throughout the presentation, please feel free to drop anything in the chat or ask any questions. And if we have time at the end, we'll make sure that we get round to answering those. If there's any other problems, please just drop me a message, that's Emily Clark, in the chat, and we'll make sure we get that sorted for you. In the meantime, though, I'm going to now hand over to David from Firenze and Sean from P1, and we'll start the webinar.
Great. Thanks, Emily. Thank you everyone for joining today. I'm David Newman, CEO of Firenze, and got Sean, who I believe most of you all know, but I don't know if you want to say hello to Sean.
Yeah, thanks very much. Hello, everybody. I recognise quite a number of names, our current users, but also some people that I don't know. So if you don't know me, I'm the Senior Business Development Manager at P1 for the platform. Absolutely going to be the star of the show today, going for everything, but I'll chip in at various points. Got a few other bits to show you as well. But yeah, David, feel free to take it away.
Sean's very much underselling himself there, but great. Thanks for the first part there, Sean. But for today, the people have signed up for this to talk about very specifically in the context of ISA allowances and Lombard lending around ISA allowances, which is a real topical discussion around Lombard lending and how it's utilised for ISA allowances as this part of the tax year. So today the focus will be around kind of how Lombard lending interplays with year-end tax planning, or specifically around kind of the ISA use cases. But more broadly, before we get into that, we are just going to spend a bit of time talking around Lombard lending itself, as I know not everyone has experience with Lombard lending. When we talk about Lombard lending and do a variety of these sessions, people come at it from different bases. Sometimes there are people that have done lending before with a private bank and really understand how it works and the products and mechanics, but often people haven't done it and it's the first time coming into it. So I think it's always best that we start with from a fundamentals of kind of how Lombard lending works, what it is a product, before Sean and I spend a bit more time delving into it specifically around kind of ISA planning. Flexi ISA planning is the case study we're going to talk about today, as it's something that's really pertinent to a lot of clients in helping them achieve their outcomes. And then we're going to move on more broadly to kind of talking about Lombard lending, how it works, the mechanics, benefits to clients, benefits as an advisor, and then specifically Sean's going to spend a bit more time on the how and how it works within the P1 platform and go through from there. But as Emily said, ask questions as go through, and we'll try to tackle them at the end. Great. But just starting, before we know kind of how to kind of where to level the kind of intro to Lombard lending, I think, Emily, we're just having a poll first on whether there's any previous experience of Lombard lending, so we know where the audience is at as a starting point.
Yeah, thank you, David. So you should now see a poll on your screen. If everyone wants to select an answer, and I'll give you all a couple of seconds to submit your choice. Great, so we're about 6% of the way there. Anyone that hasn't voted, please feel free to select an option. Okay, I'm gonna end it there. So we've got about 76% of people haven't had previous experience with Lombard lending, and 24% of people have. So we'll share those results. And thank you everyone very much for voting.
I think that's not surprising, those statistics, is it? Really kind of, we really are, with what you guys are offering via the platform, which we'll get into more specifics, but really opening it up to more, you know, advisors to be able to talk with their clients about it. So yeah, it was kind of the statistic that I was expecting to be more weighted towards those that haven't had experience. Were you the same, David?
Yeah, exactly. Because what we find is, like, historically, Lombard lending is one of those things that's only been available to people with more than £1 million or £3 million and more of assets. So a lot of people where their average client size is in that kind of 300 to 3 million space just haven't had access to be able to go do it from there. So a lot of, and when we talk about unlocking Lombard lending, a lot of the work we do is making it available without the minimums of a private bank.
Yeah, definitely.
Yeah, good. Well, so for those that 2/3 of you or more that haven't had experience with Lombard lending before, I'm going to start with the kind of the fundamentals and kind of a whistle stop of it. Hopefully, though, it is a very simple and easy product to understand. A lot of the core concepts very similar. I always analogize it to a mortgage. Ultimately, people are familiar with a mortgage. You have an asset, you have an investment, or you have a facility or a credit agreement loan secured against that asset, and you have this concept of a loan to value that we all understand and we've all been through from there before. The big difference, though, is your lenders in your mortgage scenarios, they look at the value of the asset on day one and set and forget it. Unless something really goes wrong, they really don't care about that asset valuation on an ongoing basis. Whereas within Lombard lending, it's very analogous. Your asset that you're lending against just happens to be an investment portfolio. The big difference is that obviously that valuation changes on a day-to-day basis. So when a lender is doing Lombard lending and lending secured against investment assets, they're not just focused on the value it is on day one, but they're focused on how much that asset base may change over time so that they're always protected. Whether it's Firenze or any other lender, they will factor in to their lend to value how much they're willing to lend to a client, the volatility, the liquidity, the currency, the correlation of that asset base to come up with a loan to value. And I'll come to a second, the kind of two different loan to value concepts to add a bit of complication, but ultimately it says what is the LTV they're willing to lend against this portfolio. In this very simple example we have here, a client has a £300,000 multi-asset class diversified portfolio. The lender is willing to lend 50% loan to value against that portfolio. They're willing to give that client a £150,000 credit facility. As I say though, there's two kind of actual LTVs that are really important to lenders. One is how much they're willing to lend at the beginning, the initial LTV granted against the investment portfolio. But there's also in Lombard lending this concept of like a maintain rate or a margin call rate, where you have a second LTV, the level at which a lender would ask for further collateral from the client, from the borrower. That the portfolio may have fallen so much in value that they think at that point the security is at risk, and they say either you need to repay a part of the loan or provide additional collateral or rotate into lower risk assets. So when you look at lending decisions or in Lombard lending, there are two LTVs to focus on: advanced LTV, the amount willing to lend at the beginning, and the maintain rate, the amount which a lender would ask for further collateral. And at Firenze, we try to set those numbers as far apart as possible. Obviously, we want to protect the clients from the risk of margin calls and the risk of ever having to provide further collateral, but also protecting us as a lender from the credit risk if there isn't further collateral. So we typically, on a multi-asset class portfolio, you're looking at like a 50% advance rate and a 75% maintain rate. And work that through as an it's kind of, you're looking at kind of 30 to 40% falls in the values of portfolios before clients be asked to provide collateral. But it's really important that along that way, it's not just setting those levels conservatively, it's about good communication and making sure clients, advisors get early warn notices, get margin comments, and kind of make sure they're well informed along the way. But when I talk
just on that, David, just purely on the margin calls, and just to maybe give a little bit more meat on the bone. So I suppose the beauty of the fact that you have got Firenze working in the way that they do, being able to look at that portfolio value, know what the loan to value is, what that margin call is. You haven't got this horrible clunky system where you've got a platform, you've got a lender like Firenze, and then the data is not being freely exchanged. One of the beauties of working with the guys at Firenze and working with technology like ours is that all that valuation data is sent through on a regular basis. So there's not these, massive panic stations. It's all seen on a daily basis. So you guys are well informed, and the advisor would be let know nice and early. We've seen that in practice and reality. So I thought I'd add a little bit of detail there for you.
Yeah, exactly. And P1 is one of the best integrations we've got, where the APIs feed straight through into our scanner, so we see everything in real time, and we surface that data back to advisors, so they can go do that, get the communication. Yeah, it's all in real time. When I talked about there, though, as well, of like it's in Lombard lending, I talked about credit facility, drawn balance, and things like that. I think that's just the point, is that that's only the amount that the client's actually drawn. And I think that's important, just because when we talk about Lombard lending as a credit product, it just works like an overdraft. The client draws and repays as they see fit and as they need it. It's not a case of they get £400,000 and then they repay it over a monthly basis, or it's that set amount. It is that they can draw and repay as they see fit. So it's only when they're fully utilized where you're really talking about those margin call type scenarios anyway, and they're only paying interest on what they're using. And that flexibility to just utilize it when they need it really adds a lot of benefits to Lombard lenders. We've gone to the benefits anyway. And I think you've seen it shown from a lot of the clients that have utilized it with B1, is there are some that will just draw fully and have it in kept in place, and there's some that will go and dip in and out of it and use it like a yo-yo of drawn balances.
Absolutely. Real-time examples, if somebody does have the minimum amount, which is they need 130,000 in their GIA and ISA in order to get a 50% loan to value of 65,000, the reality is that 65,000, as David quite well put it, you don't have to use all of it. It's very much that overdraft, 5,000, 10,000, what does the client need at that time? And then obviously there's the facility fee, there's the renewal fee, and then you'll pay the interest on what's drawn itself. So really simple and transparent from a client perspective as well.
Yeah. And those things that we talk about there kind of leads into what we're going to talk about today, of like the more of actual, the flexi ISA is one of the use cases where that flexibility and only paying what you utilize and speed is kind of really lends into use case. We'll go and do the use cases. But I think Sean and I we're going to kind of just talk through this example here of a client calling up and saying, look, actually, hi, I've kind of got to the end of the tax year and said, well, actually, I had a house renovation earlier on in the tax year that I drew 95 grand out of my flexi ISA for. I thought I'd have some more liquidity by now to put it back into the year, and I'm now worried I'm going to lose my tax status.
And then I, as the advisor, would almost say, you're saying you don't have that much cash available, ready to hand, just sat in your bank account, ready to put back into your flexible ISA. Does seem a shame to sort of disrupt any investments and other wrappers that we could look at.
Yeah, and I think in a lot of clients, that's nice that they take money out of their flexi ISA expecting that they'll all have it back in by the tax year end, and go, oh, I thought I'd have had that dividend from my company by now, but I had to keep it in for a little bit longer.
So yeah, I suppose then we start to really get into the nitty gritty of, okay, well, great to have these conversations. How can you really get to that stage? It's, well, looking at the P1 app, you could borrow almost 120 grand against your portfolio to pay back into the flexi ISA. So it's really sort of drilling down into how much you need. I think you forgive me and David for the GCSE drama exposure kind of thing, but it is really important to think about, how does that come about? How are you then going to react to a client, and where's it best to sort of earmark in terms of the optionality there? But yeah, well done, David. I think we get our GCSE drama certificates
We
later.
get a certificate there. Yeah, and I think that the important thing is going to discuss is exactly that. Like we're all going to everything in case from there. It's like it's a specific client need. There's lots of times when we can go onto Lombard and lots of different ways and different places that it can really drive a benefit. And it's the flexibility and efficiency of Lombard loan is a real drive value. But today, with this time tax year, it's just solving a very concrete client problem. Is liquidity is sometimes just hard to come by. Clients have unexpected circumstances, but that kind of preservation of the status of an ISA is something that's really important. So I think when we talk about this time of the end of the tax year, the things that we think about is, yes, it's the flexi ISA, but it's also just clients that want to be able to top up in the first place. Is we have a lot of clients this time of the year that will just borrow £40,000 or £80,000 for husband and wife to put in this tax year and next tax year, just because they want to just get the money into the ISA and they didn't have the cash for it there as well as the flexi ISA types use cases. It's that ability to just make sure people are maximizing their allowances is sometimes where that liquidity is, and we can come on to the kind of the economics of that in a second. But to be able to go do that, they clearly still need some assets to be able to borrow against to go do that. And people may borrow against their GIAs. And in the old day of the bed and ISA used to work very, very well, but where kind of the tax allowance are at this stage, often borrowing against the GIA to top up ISA ends up being a more efficient and economic solution rather than triggering capital gains taxes. But we also allow lending against the ISAs, the kind of residual assets in there, or we allow lending against offshore bonds to allow people to be able to have that flexibility of getting the funds into the account. And as we've touched on a few times, is they're only paying on what they actually draw. So as we come on to go through a worked example of a flexi ISA scenario, if people literally just use it as a bridge for across the tax year end, they're only paying interest for 4 or 5 days there. So working through that example, that kind of pulling that through together with the example that Sean and I talked through there, is that client that did use their house extension is what, and this is quite a very common thing we see at this time of the year, is a client saying, look, I took money out of my ISA, and it could be a house extension, it could just be they wanted it for a holiday, it could be they put it back into their business, they wanted to gift to children, they wanted to help a shower deposit for a flat, whatever it may be. And they thought, the best use of this is the advent of the flexi ISA meant I was able to take money out and I'm able to preserve my status again by tax year end. That's okay because I've got XYZ liquidity event. And for half the clients, that's absolutely fine. The liquidity event materializes, it comes through. But for a lot of people, I think we've all seen it, they get overly assumptive on their liquidity solutions. And in this example scenario here, the client's actually going, well, actually, I'm going to get 100 grand bonus from my from work, but I'm not getting it until June. It's coming in after the tax year, and I've got that kind of liquidity gap, but I want to protect the integrity of my ISA. I don't want to lose that extra 100 grand allowance or whatever it may be. There's no limits here on what can do it. So what we're seeing is clients borrowing secured against the rest of their ISA or the other assets we talked to, putting that money into the flexi ISA for 4 or 5 days, and they could do it for longer. They could just have that and topped up and repay it, and kind of keep that repay the facility at a later date. But what we often see is people do just put it in for those 4 or 5 days to actually make sure they're preserving the integrity of their flexi ISA, and then taking those funds back out so that they're minimizing the amount of interest that they pay and making it a really economic and an efficient solution. And if you look at the economics on this, in this specific example, we've tried to do a worked example here. We could pick any round numbers we like, but go for a £95,000 withdrawal there. That client that's lost there, and we've just assumed a 5 years here, but the reality is clients are investing forever and a day. This number compounds and compounds over time. But using here, that client has taken £95,000 of their ISA. And that ISA, then they've lost that allowance because that 100 grand bonus that they came in after the tax year end. It's invested in a GIA, it's invested in taxable accounts. It's not in those protected CGT and income tax wrappers. That £95,000, if it was to grow, assuming kind of your standard 7% a year compound rate, is if that was in a taxable account, that 133 grand, and then sold at that juncture, that 38 grand of growth, you'd be paying kind of £9,000 of CGT on it, even forgetting any kind of income tax along the way. It's kind of the benefit of preserving the wrapper status is massively important, and that just compounds and compounds year upon year upon year. To preserve the integrity of that wrapper, though, the client is paying a fraction of that saving. So taking in this specific example, a £95,000 facility, borrowing kind of, let's say it was a 1% arrangement fee on the P1 platform, that client's borrowing, it costs £950. They're paying interest for only 5 days on £95,000. So if we come back to that kind of the benefit there of the Lombard is you're only paying on what's actually utilized. The client's only drawn for 5 days. They're paying £90 of interest, £91 of interest. And for that £1,041, and they may use that facility, they may use it the following year, and it's only costing them £91 year 2 and £91 year 3. And so that kind of benefit gets over time. But that for the cost of £1,000, they're then able to preserve the kind of the integrity of that wrapper and save themselves over 5 years close to 10 grand of CGT and taxables, and over the future years compound that more and more and more. So the maths become very, very stark on the benefits of preserving the integrity of a wrapper.
It's a really powerful worked example, and not necessarily one that many people will think about, because as we said before, even from the poll, Lombard lending isn't something everybody's had exposure to. So it's just being able to think of it as another tool in your arsenal, thinking about what you can do. And there's loads of applications that we'll get into a little bit later, but I think that worked example itself, just of that 5-day exposure, utilizing that ISA allowance before the tax year end, before they get the 100 grand bonus, just really nice worked example that we can go through there.
Great, thanks. I think taking a step back from there to kind of actually how can you utilize a Lombard lending, and who can do it from there. So we've talked on the Flexi ISA use case and go from there, and we'll start to move on to other use cases. But I think it's just for everyone's benefit, kind of taking a step back on like actually what can you lend against and eligibility. So when we talk about eligibility for Lombard lending, we talk at it from 3 lenses: borrowers, wrappers, and assets. So borrowers, anyone, individual borrowers can borrow, joint borrowers can borrow, fiduciary structures, their trusts, their corporates, their family investment companies. The only thing that we don't allow lending for is trading corporates. Obviously, for the Flexi ISA use case, not relevant necessarily anyway, but I think it's useful to look at eligibility through that lens. When it comes to wrappers, we lend against GIAs, we lend against ISAs, we lend against offshore bonds. The only kind of really pertinent one we don't is clients aren't able to borrow against their pensions. So when you're thinking about this tax year end planning, look at the asset mix that clients got. The one thing to just bear in mind is they can't use their pensions as a wrapper to lend against. When it comes to the assets, though, it's largely lending against anything that's daily trading, anything that's liquid. The things that we don't kind of assign a loan to value against is private equity, direct commodities, and we wouldn't lend where there's a kind of single concentrate position, particularly if they're the director of that company. They've got a few million of shares in their own company. We wouldn't be kind of doing that type of lending, but most kind of advised portfolios will be eligible to go borrow from that. So to get the benefits of that use case, if they're an individual borrower, they're lending against GIAs or ISA offshore bonds, they're lending against liquid assets, they're able to benefit from that up to 50% LTV. So they only need small amounts of that, and as Sean said, the minimum facility size of 130k. So most clients are able to benefit from this access. I think when we talk kind of with those that kind of flexibility and those wider range of borrowers that can go for it, there's a broader benefits that we started to touch on through this session anyway, where a client can kind of really generate benefits from here. come back to this, but like that efficiency to me is the absolute number one. Is there's so much flexibility on what a client can use the Lombard lending for. We talk about the Flexi ISO, we'll come to the use cases, but that once they can draw and repay as they see fit and utilize those funds in any way manner that they need, and then they're doing that at very efficient rates. I think we've not talked on the rates today here in great detail and use that worked example, but clients are typically looking at borrowing at kind of between 1.5 and 3 over base. It's kind of at this rate, it's kind of that 5.5 to 7 range is where a client's borrowing, which is kind of less than generally the typical returns they make on the portfolio, but crucially less than the other types of borrowing that would be available. It's cheaper than kind of unsecured lending. It is cheaper than a second charge mortgage. It is cheaper than bridging finance by kind of 5, 6, 7%. And they're, again, crucially only paying on what they actually utilize. And given the level of integration between P1 and Firenze, a client can apply in 15 minutes and have a decision that day. That portfolio, when a client applies through P1, as Sean will come on to the how, that data is being fed automatically through P1's great technology into our risk engine to be able to underwrite that portfolio in real time so that client can get their lending decision in a matter of hours and have access to it. And there's very few other lending solutions or liquidity solutions out there that is able to give a client that level of access to liquidity that efficiently and that level of magnitude of sums in such an efficient and flexible way. I think all those benefits don't come without some downsides though. So it's really important that advisors and clients understand them. Clearly, it's like the reason that Lombard lending is so cheap, so efficient, so ability to underwrite so quickly, so flexible, is because it is secured against liquid assets that there is a ready-made price for. The flip side of that is there is a ready-made price in the market that a lender can value that on an ongoing basis. So the number one risk that we touched on at the beginning that kind of think about in Lombard lending is market risk. If a client's portfolio fell significantly, we are talking significantly here, then there is the requirement to provide additional collateral or sell some of the assets at the worst possible time. And if a borrower defaults as well and refuses to pay, we would have the right as a lender to instruct P1 to sell some of those assets. We never want to go do that, and we set the kind of the lending rates to be as conservative as possible to make sure we're minimizing the risk of that happening. But it's so important that clients understand that. I think the other two risks that are really important to consider is interest rate risk and tax risk. And the interest risk is a variable rate product, Lombard lending. It's base rate plus a margin. So the great thing at this part of the cycle is we all expecting rates to go, notwithstanding recent events, expecting generally interest rates to trend downwards over the next 12, 24 months. We pass that interest rate decrease straight onto the clients that day. They start paying less interest that exact day. The flip side, however, is for those clients that are using it for more longer term planning, their interest rates do increase immediately upon that date. The tax risk is pertinent only in the case where things go wrong. I say we lend against ISAs, we lend against offshore bonds. I think it's important that clients understand is if they were never to pay back and we had to go through court orders to go to sell their assets through an ISA, that could potentially invalidate the status of their ISA. And again, only if they're not paying, only if they're paying things wrong, but it's an important risk to be aware. And similarly, but through a different lens, is within offshore bonds. If we ever had to enforce, we're not looking at top slicing relief. We're not considering spreading that over year ends. It would be taking those funds back from there. Again, hopefully relatively limited risk there in the context of the conservative lending and the types of clients utilizing it. But it's just important that clients and advisors are aware of the downsides that come with the amazing benefits that come with Lombard lending. I think naturally there are some benefits to advisors as well. Obviously the key benefit, and I think first and foremost on ours, it solves a client need. Ultimately, we talk about the kind of the way it can drive liquidity, the way, and it's not just about specific, we're talking about specific liquidity needs here in the Flexi ISA use case, but more broadly, enabling clients to think differently about their wealth and to help them achieve their wealth outcomes through using both sides of their personal balance sheet is the way I always like to think about Lombard lending and that ability to drive a client outcome. But that is the kind of first and foremost is helping our clients. But I think more broadly as well, it also has that ability to help an advisor just attract and retain AUM. It's ultimately that ability to go find those clients that you're able to offer something different to by being able to talk to them about a liquidity solution that they're only typically able to get from a private bank. Or it's that ability to prevent assets leaving when a client has a liquidity need and they sell their investment, they disrupt their investment plans. It hurts them, but it also hurts the AUM and retained revenues of the advisor as well. So These should be secondary. It should be about a client outcome and a client goal first, but it's remiss not to say there are benefits to the advisor as well. And through doing it this way, through the integrated solution P1 have, is the advisor stays in control the entire time. It is not then passing it off to a private bank that then tries to pitch the investment solutions and kind of wants to control the relationship. The advisor stays in controls and gets to own everything, and it is purely a nice, great add-on service that's available through the P1 platform. I think, sorry, is there anything else to add there, Sean?
No, it's just to say I think probably a good time for another poll. So just yeah, what other use cases can people think of regarding Lombard lending? And it is one of those, because it hasn't been available to lots of lower value clients, you know, with these high AUMs, you know, whereabouts do you see most of this being? So for those of you that have dealt with it before, that voted in the first poll, you know, whereabouts are you going to be using it? And then for those that haven't come across before, you know, where do you think you might use it? So we'll give you a couple seconds just to get some votes in there.
Yeah, thanks, Sean. So you should see another poll on the screen now. If everyone's got one vote, which use case do you think you're most likely to use Lombard lending for in the future, or which do you think would be the most useful? So I'll give everyone a couple of seconds just to read through the options and cast their vote.
Bit of a battle going on there between IHT planning and tax planning by the looks of it, as the mass majority. Makes perfect sense. Nice to see that there's some other things in there like gifting and then things around bridging loans and stuff as well.
Right.
Not as many votes for luxury purchases.
People not using a Lombard loan to go on a holiday.
Okay, I'm going to end the poll there. So we've got 41% can see themselves using it for IHT planning and 36% for tax planning. And then there's about 10% for bridging loans and gifting. And then finally, we've got luxury purchase. Thank you so much for voting, everyone.
No.
Perfect.
Great, and that chimes a lot with a lot of what we see in the kind of use case as well. I'd probably say the only, I think, like the kind of using it for planning, in particular, like when you do Lombard, like a loan to gift is very IHT efficient. It is, you're reducing the value of the estate. We see, I think one of even our largest facilities is clients that are borrowing. They want access to their assets. Like for instance, you've got a client that's got 800 grand to $1 million. They're worried about have they got enough for themselves, for their later life, for their goals, but they want to also support their children onto the property ladder, and they want to be able to go think about their IHT. They will borrow a few £100,000 against their portfolio, set up their children, achieve both wealth objectives, but also in the same time they're reducing 300 grand of the net value of their estate and helping with IHT planning. So it's kind of serving multi-purpose goals, and from there, and I think the IHT plan is a great kind of use case from there. I think the one we see a lot of that's probably is surprising, that it's probably only kind of 10 or 20% there. I think only that came through on property and bridging is probably the most common use case we see, is clients downsizing properties and bridging property transactions. I think the team joke about financing half the bungalows in the country at this moment in time, as clients will come to and say, hey, I'm downsizing, I've found my dream house, but I don't want to be in a chain. I'm considering selling 800 grand of my portfolio to go finance the property. And the advisors go, no, wait, actually, there's a better way. Why don't you borrow for 6-7 months? And then when you've sold your house, you repay your Lombard loaning rather than disrupt your investment plan and kind of trigger CGT along the way.
I'm sure many of us that have been in chains and property sales and things like that could yeah, definitely understand the value of being able to bridge that and pay some money towards getting that so much easier and get it moving much smoother. So yeah, I can see that from definite.
Yeah, great. But as I said, the flexibility, the efficiency lends itself to lots of different use cases and lots of different ways to help it. So hopefully, as people feel more and more comfortable and have done 1 or 2 cases, or we always find when people have done 1 case or 2 cases, they then actually unearth loads of clients that actually really helps them achieve their wealth objectives in lots of different ways. Planning is crucially a part of it, but it is more broadly thinking about clients' outcomes. But I think with that, it's good to move on to the how.
Absolutely. Thank you, David. If you don't mind continue to drive, that would be amazing. So to start with, I suppose the thing that we always want to highlight is that it is a tool, it is an option, it's allowing you to signpost clients towards the option of doing this, of taking out a Lombard loan. But how do they do that? So from our side, from P1, what we're currently looking at is our advisor UI. So on the advisor UI, when you go in to look at an individual client, you'll be able to see a loan to value that could be achieved through what the client's got through their ISA and their GIA. On the client's perspective side of things, the client would be able to go into their app, they'll be able to see the borrow functionality in there, and they'll be able to follow through the process. If we move on to the next slide, we'll then be able to see, once you're in the individual portfolio itself, you'll be able to see the actual facility that could be achieved. And once the facility's been put in place, i.e. the client's gone through their process, what you also have is, from an advisor side of things, you can see the facility that's in place, how much the client's drawn. So if in the eventuality that David mentioned, where you've got a client that's got a loan facility of 150 grand, 200 grand, if they've only taken 40 or 50,000, and then equally if they look to increase that going forward, the optionality's there, and they're already paying for the facility. So just add some more of those optionalities when it comes to planning for your clients. But the process from the client side, which, starting on the next slide, just really simply, once the client goes into the borrow facility, they've only got some really simple areas to complete. Things around setting up their account, so registering an email address, completing some basic information, going through a learning process, so going through what is a Lombard loan so that the borrower understands the risks that are involved. Because this is, in a lot of cases, as we say, a signposted product by advisors for the client to go through the process, it's really important that they understand it. The questions aren't overly complex, but the reality is it is just making sure that they understand the risks involved. Then they'll just complete their personal details, finally update things around the portfolios, what they would like to access, obviously the way in which the things are set up as well, so how are the payments going to be taken, any extra details that are there. But the reality is, from creating the actual login itself, going through the process, getting their accountant to confirm that they're high net worth, all of that can be achieved in a really short space of time. And as David said, it could be the case of the client having the actual facility or the money in their bank account if they're drawing on that facility straight away within a matter of a day. So it really isn't a long or drawn out process at all. We might have to start recording some record stats for how quickly things are put through, so we can start to really give a little bit more meat on the bones with this. But as I say, once the client's there, they know what the facility is, they know what the portfolio value is, they got a lovely visual on their side when they log in, they can see how much more they can take, and a really simple and straightforward process, with all the benefits of it being linked to an advisor-led platform. So as David said, it's not in a private bank. We as a business value the advisor relationship. We want to add more tools to the advisor's arsenal to make things a darn sight easier when it comes to IHT planning, bridging loans, optionality there.
Cool. Talking about the advisor's arsenal.
I say Arsenal, and then there might be people that are akin to football, and I've offended some people. I'm not a football fan, just to put it out there in case that does offend anybody. So I pick my words a little bit more carefully next time and talk about it being in your toolkit and not your arsenal.
Thanks, Sean. Thanks, David. So there's one final poll that I'm going to launch now. So do you think Lombard lending will be a key tool for advisors in the future? Yes, no, not sure.
I think if people are in the camp of not sure as well, I suppose from mine and David's interest, if you have any questions, we'd love to answer them. But equally, if you don't feel that you can ask the questions now until there's an option where a client could benefit from it, the door's completely open. There's plenty of account managers within P1. There's plenty of team behind the guys at Firenze that would happily give you the answer and the reassurance so that you know what that option is. But yeah, if you just want to ask the questions now, I'm more than happy to spend the time.
So I'm going to end it there. So we've got 53% say yes, they do think it will be a key tool for advisors in the future. 47% aren't sure, but luckily no one's saying no. So well done, guys.
Just
are there any questions? Were there any questions that did come through during today at all?
Yes, lots. So thank you so much for your attention, everyone. We are going to jump into some Q&A now. So thank you, everyone, for sending your questions through on the questions chat. So first question, probably to David. There was about 3 people that have asked, is there any reason why we can't consider onshore bonds as collateral?
Good question. It's not that we can't, it's that we haven't had much demand for it, in all honesty. So we've set up with a lot of the offshore bond providers. So we work with Utmost, we work with Kind of Life, we work with Standard Life. We just haven't seen demand for as many onshore bonds. If people come to us with specific cases, it's only a little bit of legal work on our side to work with the providers to make sure it emerges up from there. It's just an honesty. So it's good that 3 people are asking about that, because that tells me there's more demand than we've seen. But we haven't had. I think we've only had 1 inquiry to us in the entire time we've been lending for lending against an onshore bond, because the clients have had other assets that we've been able to lend against in the first place.
And I guess in the same theme as that, there was also a question around accepting property or a property portfolio as security. Where do we stand on that?
Yes, that's not something Firenze do. We do one thing and do it super well. We do Lombard lending. We lend secured against liquid assets, and that's why we work with the P1s, where we can kind of have that visibility data. I think it's a watch that space over the years ahead, where we might in the future lend kind of hybrid structures, where we do a bit against property, a little bit against kind of their Lombard, and try and find optimal solutions. But at the moment, it's kind of, I'd go to the banks or the specialist property financiers for property finance and asset. You come to Firenze, where a client's got liquid assets and wants a very cheap and efficient, quick solution through security of the liquid assets.
Thanks, David. So maybe this one's for Sean. I don't think P1 offers offshore bonds. So how do I borrow against that on the P1 platform? Sean, do you want to take that one?
Yeah, cool. So we do offer an offshore bond. It's with Canada Life as a third party, and we are looking this year to extend that to Utmost, and then also at the same time we'll be looking at an onshore bond version. So yeah, there will be that optionality. I think currently our proposition with the guys at Firenze is purely GIA and ISA, but there's always conversations going on as to how we can extend that to other products. But yeah, feel free to get in touch with your account manager or me. More than happy to give you sort of some rough timeframes to allow that facility to be available in the future.
Great, thanks, Sean. Back to David, I think. Does the 50% initial loan amount vary over time? So that if the portfolio increases and then they draw down in 2 years' time, will that initial loan amount or a loan facility increase along with their portfolio value?
They could request a further increase. We give like an initial facility limit based upon the outset value, and suddenly it doesn't automatically decrease just because the portfolios fell the next day and they try to draw. We honour the original limit that we set. But if the client's portfolio has gone up 2 years later down the line and they want to increase that £500,000, £600,000, that's absolutely fine. They can put through that request. But as a matter of course, it's a single limit that's set.
Great, thanks, David. And then another one that's a bit more operational. So how is the interest deducted monthly? Is it from the client's bank account?
Yes, direct debit directly from the client's bank account.
Great.
Part of the setup process that I briefly went through, you will include the bank details as to where you want that money to be taken from. But yeah, exactly that.
And then there's another one which, Sean, you might not like. So which other platforms and providers does Firenze have TOB with? And there was a sorry, Sean, at the end from that person.
It's all right. We don't as a platform. Go on, sorry, David.
Firenze has the most efficient setup with P1. I think like I will answer the question for you a second, but I think it is worth saying that P1 is the most integrated, and the people we've been working with the longest, so we're doing some of the most kind of exciting levels of future integrations for actually pre-surfacing LTVs, showing more visuals back to clients, going from there. So P1 is definitely the platform we are most integrated with, and I think gives the best client experience. And if you want the assets quickest, I think P1 is probably the only platform where we could actually get a facility live within the same day. They're super integrated. Notwithstanding that, we do recognize advisors have assets on multi-platforms, and we'll answer the question. We currently work with AJ Bell, Parmenion, and Soderbergh as other platforms, and we a few more going online later on in the year. And we also work directly with a lot of the DFMs for their kind of direct client business as well. So we work with Canaccord, with Brooks, through to kind of the Altoriuses, the Lunas, the Sinners of the world, and kind of the likes of WNM coming online shortly.
Great. And I think this is the final question from Andrew. So would Lombard lending speed up drawdown and withdrawals for clients needing money and not having to wait for assets to sell to cash?
I think it will depend upon the assets and the platform and the process. I'm sure if you want to add in afterwards, but it's, yeah, if a client has an existing facility in place and they wanted to draw down on it, they could have funds in. If a client sends a withdrawal request by 2 o'clock, they will have cash in their bank the next morning. So if in that scenario, if it's quicker for a client to get funds the next morning, if they've already got an existing facility in place relative to that specific asset base and that settlement period, then absolutely. But sure, I don't know if there's anything you want to add on.
Yeah, just to be clear, obviously it was drawdown and withdrawals. So just in case the drawdown was relating to a pension, this doesn't link to a pension, so that wouldn't work in that capacity. But if it's just drawing down, as you say, selling the assets and getting it to cash, yeah, I completely agree with David. If it was a large amount, somebody could take that facility, have it put in place quite quickly. Many assets do take a good few days to sell to cash, and then obviously get paid out as a result. So yeah, it would be a couple of days difference between a normal payment and whether it went through the Lombard loan. So definitely one to consider.
Great. Thank you, guys. That's the end of your questions. Really good Q&A there. Thank you, everyone, for submitting your questions to Sean and David. Thank you so much to everyone for attending. We're pretty much up to time, so that was well timed, everyone. Well done, Sean and David, for keeping to the 45-minute slot that we had. As you can see on the screen, if you want any more information, I'm sure Sean will suggest you would also talk to your P1 account manager. But if you would like to talk to Firenze directly, there is a hello@ email address there where you can get in touch, or just contact David directly on LinkedIn. I'm sure he'd love to hear from you. But yeah, thank you so much to everyone for attending, and we hope you found this useful and informative. And thank you, Sean and David, for presenting.
Thanks, everybody.
Thanks, Sean.
Cheers, Emily.